Federal Reserve just cut the Fed funds rate 25 basis points as expected, and they set the bar higher for future cuts. At the beginning of the year, many people saying the Fed only going to be able to get one cut in, no cuts, two cuts. We've been saying all along we think the Fed will cut 3 times, and sure enough they did, and the reason being the weakening labor market. And Jerome Powell really sounded a lot more dovish with this cut than many people out there in the market had feared. He went out of his way to underscore the weakness in the labor market, saying that he thinks the BLS is overstating jobs every single month by about 60,000 because of this ongoing systemic issue they have. Sound familiar? We've been talking about this for quite some time. It's quite validating to hear the Fed chair say it, and he thinks that since April, there's about 20,000 job losses per month. Additionally, he really downplayed inflation, saying that yes, there's cumulative inflation from prices rising over the past few years, which is 100% true, but the current rate of inflation, he's not that concerned with. He thinks there's a big temporary impact from the tariffs, and in fact, he said when you remove the tariff impact, it's pretty close to their 2% target, just above it. Now, he also thinks that services inflation is coming down, but it's being offset by goods inflation in the sectors where tariffs have an impact, and he thinks that tariff impact will peak in Q1 of next year and then begin to fall. So really underscoring the weakness in the labor market, not too concerned with inflation. It seems like Powell has really kind of turned the corner a little bit here. But remember, I did say that they set the bar higher for a January 28th rate cut, but you almost have to take everything that the Fed is saying right now with a big grain of salt, because the makeup of the Fed is going to change materially in 2026. Remember, there's 12 voting members, and you have 8 people that are on the board, and then you have 4 rotating Fed presidents. Well, the Fed president's going out and the new one's coming in. It's going to be getting more dovish. And then, of course, Powell's term ends in May. So he's going to preside over the next 3 Fed meetings, and then President Trump's going to appoint somebody, where right now Kevin Hassett seems to be the front runner and potential winner, but we don't know. And they are going to be much, much more dovish and inclined to cut rates. Let me show you a quick chart here that just demonstrates the Fed voting members next year and where they lean, whether it's dovish, meaning they're more inclined to cut rates, hawkish, where they would be against cutting rates, or a centrist, which means they're kind of middle of the road. And oftentimes when you're middle of the road, you get swayed by the Fed chair and you fall in line. You could see here that the Fed chair, we know, is going to be either Hassett, Warsh, or Waller, but right now Hassett's the front runner, but all of them dovish and thinks there's a lot more room for rate cuts next year. And then you have the New York Fed President Williams, Bowman, Waller, Mirren. Right now he's the super dove, but he's going to be done in January. That means that the president gets to put somebody else in that spot. So we know, as presidents always do, they appoint Fed governors with like-minded thinkers to themselves. And then Paulson, who spoke just this morning with some dovish comments. So you have 6 really clear doves here, and then you have 3 centrists and 3 hawks. Compared to the makeup that we see in 2025, this is getting a lot more dovish. And the main thing being in May of next year, you're going to get a very dovish Fed chair, which holds a lot of sway. The bottom line is, Fed's going to be more inclined to cut next year, especially if inflation doesn't start to rise and in fact it cools off, which means that the neutral rate keeps moving lower and there's even more room to cut. But you might be wondering, how is this going to impact mortgage rates and asset prices like stocks and cryptocurrency? We have to remember, the Fed is not cutting mortgage rates or the 10-year Treasury. They're cutting an overnight rate, a very short-term rate that banks use to lend to one another. It has a direct impact on your money market accounts, credit cards, car loans, short-term treasuries, things like SOFR. But it has more of an indirect impact on longer-term rates like mortgage rates. Now, if you look at a chart over time, it does have, not in lockstep, but a very well-followed pattern where mortgage rates do follow the Fed funds rate. So I do think that it should help, especially if we get cooler inflation and weaker labor data next year. But then with asset prices, well, the Fed lowering rates, it removes restriction and it introduces more liquidity into the markets, which always usually finds its way into stocks, into cryptocurrencies, and risk-on assets, or assets in general. The other big thing that I wanted to mention that the Fed did is they introduced a form of quantitative easing, where they said because of liquidity concerns, remember, they stopped the runoff in their balance sheet, They are reinvesting any proceeds that fall off the balance sheet back into Treasury bills on the mortgage-backed security side and back into like maturity Treasuries on the Treasury side. But to make sure they have smooth and functioning markets and they address some of these liquidity concerns, well, December 12th, at the time of recording this, they're buying $40 billion a month in Treasury bills. They said they're going to do that for a few months, see where the market is, and maybe adjust that downward. But boy, this is adding to their balance sheet, adding more liquidity. And oftentimes when they do this, we see asset prices rise.